Welcome to the Dividend Talk Podcast, episode 217, third quarter dividend portfolio performance. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit EuropeanDGI.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. The third quarter kind of went and we didn't even notice it.
Yes, it went really quick. Yeah, that's, we're saying every week that we were really busy, right? And that's probably even the result of it. But also we had an amazing guest last week. So, I think we deserve a pass on this one.
Yeah, of course. We got lots of great feedback, I have to say, from that podcast. And I said it last week and I say it again. It's always my favorite ones when we have members of our community, just ordinary people like us coming on and sharing their story, because so many people can relate to it. They're not trying to sell anything, they're not trying to do anything, they're just sharing their story, and I find it amazing.
And also he has a slightly different approach than we have. It's also dividend growth investing, but he shifted really his portfolio more towards the income factory style, right? Which is, I think, very interesting then to hear how that works practically. What is he buying and such? So he also shared his holdings later on this week on Facebook, so everyone can have a look there if they didn't check it yet. And last but not least, he was, of course, very nice to hang out with. It was a real pub talk for me, a beer with it in the pub. That's really how it felt like last week. We could have talked for 2-3 hours more.
Yeah. And that's what we aim for. We always say it's pub talk, and that's exactly what we like. So thank you, Manny. Hopefully we will have you on when you are retired in less than 2 years' time.
Yes, exactly. Good.
So,
yeah, there's just one thing in the news of the week that I want to discuss, and we actually never really talk about this stuff. Well, sometimes. But I wanted to mention that the main news of the week, of course, there were earnings. We'll get back into that also a little bit this week. We'll touch on that. But for me, actually, was that the ECB is now reducing interest rates by another 0.25%. And then you may wonder, well, how much is that? Well, I just wanted to put everything together. And, in July in 2022, it was still on 0%. And then they bumped it with 0.5%, right? Then in September, another 1.25%. And then another 0.5%, right? And then another 0.5%. And then another 25%, all in a year. Yeah. So in a year, it went to 2.75. And then actually, even there was still a hike in September 2023. So there was a lot of hiking going on there, but now it started to decrease again 3 times in a row. So we can really see that the market, that the ECB is now correcting. And if you do 0.75% in half a year, it's quite a lot, right, for the ECB to do that. So I wonder, are they getting afraid or something like that? We can see, of course, in the reports, if you think about LVMH and such, that the consumer is weakening, mostly in China, but also in Europe. Very interesting. And it's a bit of macro. It does not directly impact our stock so much, right? Specifically, not our portfolios. Maybe in the share price, but not so much in the dividends and the earnings power. Yeah, I was just wondering, like, what do you think about? We're not used to this so much, right? The ECB usually they follow the Fed more.
Yeah, yeah. Sometimes when it comes to rate setting and cutting, we can be a little bit ahead of the Fed sometimes. But I think this really pays into people with mortgages that follow this, and it has an effect on them. Because I remember when they were increasing the rates quite rapidly towards the end of 2022 and 2023, the rates were going up, and the banks were quick to pass those rate hikes on to customers and mortgages. And I don't know what the culture is like in Poland or in Europe, but I know in Ireland there's a lot of people on variable mortgages, and there was a scramble to fix.
It's normal here, variable.
Yeah. So there was a scramble to fix their because we were quite low for a large period of time. So when people started seeing an extra 200 or 300 creep up on their bill, it can add up. So there was a large amount of people fixing their mortgages, but now they're coming back down.
Yeah.
People will see a little bit of pressure eased off them.
And that's where it matters to me, for instance, because it directly influences my savings rate. Maybe not the ECB directly, but the Polish setting of the interest rate, which is also a bit influenced by what the ECB does, but it directly influences my savings rate. So yeah, it's interesting to see how it goes. Do you think that we would get back to a zero interest rate policy?
You never say never, but I don't think so. I don't think we'll ever go back that low, but I mean, you don't know what the
I think we will be closer quicker there than we may expect. I think I think there's almost no alternative if they really. I mean, it's kind of a weak man's policy, right? Politicians need to take action, the right action, and not taxes to death, right? Because for the ECB and the Fed as well, they're usually just trying to make up for what politicians screw up on.
Yeah, which is like, it's like a circle, isn't it? They're just chasing their tail the whole time. It's
exactly.
Going,
but the good thing is, in these kinds of things, usually investors in stock market benefit from these kinds of things. So that's a good thing.
It is that, and that's why it's important to invest. So you're not a slave to that kind of system, waiting on them to cut the interest rates. And of course they'll be printing money like there's no tomorrow, I'd imagine too. So
yeah,
that always goes into the stock market. Well, if we can take history with what happened in America when they were printing, we could see the amount that printed, the stock market rose by that amount. So
exactly. So hey, but this is a really great segue then into the main topic of today, because today is Q3 earnings, and our Q1 and Q2 earnings were quite interesting. To use this word, right? Interesting always means something special.
Yeah.
But I believe you really have a big milestone also to celebrate, or not?
Yes. And we know I've been chasing that elusive 100K mark, and I finally passed it. And it's so funny because you'll remember over the last couple of quarters, I kept saying I was close. And it almost felt like the market was moving up. And then as soon as I nearly got there, it dipped a little bit, and I had to invest more and more. And then I passed it. I can't remember what month I passed it. I know I wrote it in our newsletter, but I passed it. And now that I've passed it, it just seems to accelerate. It's like it goes in a straight line up, and it's gone up nearly 10% more since then. So it's been crazy. But that was a huge milestone for me. It's something that I've been chasing. It took 6.5 years. If I remember, it would have been quicker, only for my little foray into the options world. And I've lost, I won't say I lost, but there was money that I invested into that. I still hold two of those companies that have 98% loss. So if I took the money from that and put it in, I would have reached it maybe at the start of the year, which is a big learning. But yeah, it was nice. I came home from Las Vegas. I didn't lose all my money. I had money to spare, and I did a late splurge, and that pushed me over the edge to over the 100K. So proud moment.
How does it feel now? Because you always heard this Charlie Munger quote about the first 100K are a bitch, right? And how do you feel now about this?
So I actually feel quite proud of it. And it's something then I was sharing my son and that, and he's looking at it, and he's looking at all the zeros and going, his mouth is open, going, I can get, no, it's kind of like an inspiration for him. But yeah, I was quite proud. I opened up an expensive bottle of whiskey, one that I held. It was like a single casket whiskey that I had for a couple of years. I said I'd only open it for a special occasion, opened it. But you know, life goes on, and you have to set your next target, and that is €1,000 a month in dividends. That's my next target.
Nice. Before tax, right?
No, after tax. After tax.
You're like torturing yourself.
I am, but I always feel that if I look at it before tax, it's not really my money. The tax has to go somewhere. So it's like teasing myself. It's like dangling a carrot that's not there.
But do you then also think in when you are at work, do you think in net salary or gross salary? When they ask you when someone asks you how much do you earn, do you think then in gross salary or net?
I'm always net. I always think in net. Yeah.
Oh, that's interesting. I always think in gross.
Yeah, because it sounds more impressive, yeah, because we're on a higher tax rate, but in reality, you don't see half that money.
I think it's more because gross salary in the IT market, you can compare a little bit better internationally.
Yeah.
So when I start talking about net salary, I usually put it in the context of purchasing power.
Yeah, if you're comparing across geographical regions, yes, it makes sense. But when I'm at home or if I'm making decisions or talking, I always deal in net. What I have in my pocket, that's what I count.
Yeah. Oh, good.
So we get into the juicy stuff. You know, my target is 1K a month. Well, over the last 3 months, I'm halfway there. So my July income was 678. This is after tax, after withholding tax, but I still have a small amount of tax to pay at the end of the year. And I'll deduct that at the end. But 678 in July, 550 in August, and 549 in September, which is actually, I didn't realize it's crept up to be consistently above the €500 mark, which is nice, because I know I get larger amounts in April, May, March, April, May, because of the European companies, but I'm not typically getting the European companies here. So it's nice to see I have some buffer here of 500 a month, which is also a nice milestone, I must say.
But it says also a lot about your portfolio yield.
Yes, we know I have a higher yield. I worked it out. It's close to 6%, but if I take the tax off, it's around 4.9, so closer to 5% after tax. But you know, we had a couple of episodes talking about high yield, and it does, doesn't it? It gives you food for thought. Like, can I accelerate my generally is what goes through your head, but you have to think of the risk. And I think I spoke last week that Europe, it's a little bit harder because you're going into single companies. So, but yeah, if I could sell some, if I could go all high yield, maybe be at 1,000 now, but that's not going to happen. Some buys this quarter, BAE Systems. I spoke about them on the podcast. I was asked about why them and not Lockheed Martin, and it came down to valuation. I bought Brookfield Asset Management. I shared that on the newsletter, and it's been quite nice. I bought 70 shares of them. And I was planning on adding more at some point, but they're already up 25% since I bought them. And they've announced since then, they had like their capital markets day, and they're expecting like 15% dividend hikes over the next 2 years as well. So already some nice gains, and hopefully more importantly, some nice dividend gains to come from them. I bought Greg's. You know, Greg's, that's one of my low yielders in the account. Hornback, after your article on them actually, and I keep adding to JP Morgan Growth and Income Fund. It's a investment trust. You might have heard me speak about them, but they have a mixture of dividend stocks and growth stocks, and I think it's a nice diversification. It's a relatively low yielder in my portfolio anyway. It's just under 3%, but it's a nice holding. My largest holding remains Agree Realty. Mainly in part, they're up 28% in share price since across my average cost base, say. So that's drove them up into the first
Yeah, but
position.
you bought them at a really nice momentum, right?
Yeah, yeah, and I had strong
Yeah,
conviction in them and kept
yeah,
buying and kept buying.
yeah,
I
really
wasn't
good.
I wasn't finished buying them, I have to say. But there you go. I think they're priced out of my fair value range at the moment.
Hmm.
But again, we don't know what will happen with these rates and
Exactly,
stuff, so it might
exactly.
come back down.
I'm
Um,
just checking, but it is also quickly becoming a large position in my portfolio. It's still below realty income, but not that much difference anymore. It's like
yeah,
a 10% smaller position.
yeah, it's had a really, really nice run up, I must say.
Yeah.
Then my paddy has grown 1% quarter over quarter, which, given my portfolio size, is not actually too bad. So
Yeah.
I'm now 21.22% of my way to financial freedom.
Wow. So, I mean, I think you should be really proud on yourself, and to get to the 100K in how long, how much time it took you?
6.5 years.
Yeah, it took me also about 5.5 to 6 years.
Yeah,
Yeah, there. So I think you're kind of on a similar path as I experienced, because you're now also growing in income, right?
yeah,
Over the years,
yeah,
while the inflation bump probably in expenses you have felt, but you should have more money at over the years to dispose, right? To invest, besides the dividends, of course, that you're reinvesting. So that's the power as well, right? It's not just the 6 years that it takes because of you're continuously investing the same. No, if you are performing at your work, your income grows, and if your savings rate with that grows as well, then you get more to invest, so you get also quicker again, right, in the upcoming years. So it's not
yeah,
just only the compounding, it's also the increase of the savings rate potential that you may have, because probably with your age you're still 10 years away from peak earnings, typically.
yeah, yeah. Still a bit to go, but yeah, you can see the snowball on both fronts, both in the investment, the savings, and in work. And it's like that trifecta that's growing,
Yes,
helping you grow that portfolio. So
exactly. And I always keep reiterating that to others, like, guys, because it's so easily to get into the mode of thinking about fire, retirement early, and then start losing motivation at work. But actually, your motivation at work is actually really important, yeah, and how you show up and how you perform, right, and how you invest in yourself. This growth mindset is really important over the years here. This curiosity, it doesn't apply only to your stock portfolio to want it to improve, but also to your own skills, yeah.
yeah, yeah,
Yeah,
and
nice. So hey, maybe I can share a few things for me. Q3, if I would be a CEO, I would have said like the cash flow was a bit less this time, mostly due to the capital expenditures. Yeah, or no, investments in property, plants, and equipment, or something like that. Because I bought a car, as you remember. So I only had a third of what I'm usually investing to deploy as cash, because I really didn't want to take a loan or anything. So I scraped every penny that I had together to pay this car, and I needed also 2 months to refill my emergency fund a bit. So that was my focus during this quarter. So the funny fact was when I just looked into it, in July and August, I didn't buy anything other than reinvesting the dividends of Unilever and Shell, because those are both UK stocks, and in Interactive Brokers I could do a drip there. So that's only what I bought then at the time. And Iberdrola, I also reinvested some shares. But if you then think about what I bought in September, it was ASR, Paychecks, and Evolution Gaming. Paychecks was also one of those articles that I wrote for the newsletter. And I feel like, oh yes, this one really fits in my portfolio. It's an area that I haven't covered yet. Yeah.
yeah,
And I didn't sell everything, but I sold, I believe, half of my position in BASF. The other half will come somewhere in the upcoming months. The interesting fact here is that if you think about my dividend income growth, it was 44% up in April compared to the year before, 34% up in May, and 19, almost 20% in June. Sorry, I'm having it the wrong months. This is July, August, and September. But on average, almost 29% in Q3 growth of dividend income. That's insane still, right? With a larger portfolio to still be able to do that. I think it has a lot to do with the insurance companies that I was buying last year. Those are high yielders, so they beefed up my portfolio yield as well. And yeah, they've been paying also the dividends in September, like NN Group and ASR. So that really contributed nicely, but also the rest, right?
Yeah.
An interesting statistic now is that my expense coverage ratio is around 69%. But if you look at my target portfolio that I'm looking at, it's almost 75%. Why is this? Well, my portfolio has been on fire in this quarter. Yeah, the portfolio growth in absolute value was 5.9%, which is a lot in a single quarter. I think year to date, I mean, I don't really calculate this, but I was looking at it the other day, and it's probably I'm around 15% up. I think the average market is 19% up, so I'm underperforming. That's usually on in this if you don't account for the yield, right? Because if you take the yield and you reinvest it, I'm probably kind of almost in line with the market trend. But my portfolio yield now is at 3.6%. It declined from 3.8, so slight decline, and that's mostly because the portfolio value picked up. My largest sector continues to be information technology with 18%. This was 19%. My largest holding continues to be Shell with 6.18%, but it was 7.26% because Shell dropped a bit in price. But it continues to be my largest holding. Also in gross dividends, I get the most dividends from Shell. Yeah. What is else interesting maybe for the listeners? Because I deployed less net cash this quarter, so 50% actually of my investments did come from the dividend income, which is interesting. And my PADI grew only by 8.8% quarter over quarter because I had much less to deploy, but also I had to update the incoming dividends from, for instance, BASF. Yeah, here. So it gives kind of an artificial PADI decline because if I reinvest BASF in a high yielder, then which I typically tend to do because it fits in that category, it will bump up again. Yeah. Maybe not with a few percent more, but with some. So yeah, all in all, I think given the fact that I didn't deploy a lot of money because of a car, buying a car, I'm quite satisfied with the portfolio again.
Yeah, and you can really see the benefit of having a large portfolio and all them dividends coming in, because if you were a small portfolio, if you're a relatively small portfolio like my size, and you didn't invest in those 2 months, it would be a bigger impact because you're not investing as much in dividends.
Yeah, but the dividends are really compounding now. They're so much contributing to the reinvestment. It's really nice to feel and to see.
Yeah, it is quite nice to see. And looking at that trend, I always say, I always feel like I'm on the stairs following it, and that's my goal. So yeah, no, it's nice month.
I'm getting close. I really feel like what Many Mystery said. I'm now in the I'm now starting to have the fourth quarter of my financial independence journey.
Yeah,
it's starting to enter slowly. So I think maybe by the end of the year, if I'm lucky, I may be at a 75% expense crossover, and then I'm really hitting the fourth quarter.
Do you think you'll stay more disciplined as you hit that, or will your thoughts change, or is there anything tempting you?
No, this year, for instance, I already spent much more on vacation.
Yeah,
because I always say, like, I want to retire in 2-3 years, or not retire, have this financial independence goal, but I also want to not be a Scrooge at this moment in time while my kids are at an age that they can experience a lot and we can build memories. So I did loosen up a bit, so it may be visible in the savings rate. I also brought the purchase of a car forwards a little bit. So I did splurge a little bit this year, because I mean, I really don't mind if I need to work a year or 2 or 3 longer, because I'm building memories now.
Yeah.
But the
And
discipline is important. I'm still like, now again, every time when my salary comes in, the money goes out. Yeah.
yeah, yeah. It's nice to hear. It's definitely with the end so close in sight, or not the end, but with the goal so close in sight, it must be reassuring to know, okay, it's there, so I can loosen up now. I don't have to be as strict with this, because you know it's within reach.
Yeah. Exactly. Yeah, exactly. But the discipline got me here, right? It is more like the vacation part was just more expensive, because we choose to do that this year, because it's just the right timing. Why would I delay that to later, and then the kids are already like, you lost the momentum. Yeah.
I'm teasing you a little bit. I know you quite well. I know how disciplined you have, so it's not a question. But yeah, it's nice. So I think two nice quarterly earnings. I'm looking forward to seeing how we finish off the year. So yeah.
Oh yes.
Earnings. We got quite some questions, as you would expect, about ASML, and we didn't cover them in the news of the week for that reason. Intelligent Investor, Yedia, Aysin Wallakaviv, and Anders Stogard have all asked us about ASML. And why?
Yeah.
Because the price has been dropping. So tell us, what did you find?
Well, generally speaking, ASML is just struggling from a weaker demand at the moment. Actually, today I saw that Samsung is postponing, I think, their purchase. Well, I think they purchased already. They paid already for like I said, an advancement, but they are delaying, let's say, the delivery of that. They are postponing the delivery of that, because they're just facing all weaker demands. The foundries are in America with bring the Chips Act are not going so fast as they are expected. I assume that Intel is also in there. Intel is struggling with their chips. So, if your chips are not being bought, or there's not a lot of desire for it, then you may also think a little bit about your EUV machines, right? How quickly you want them to hit your cash flow. So I didn't see directly that they mentioned Intel, so it's my speculation here. But Samsung was really a news announcement. But I mean, where really the impact is, I think, is on the margin. Yeah, the company wanted to have, I don't know exactly, but let's say up to a 55% margin or something like that, and they are rather now aiming for Q4 around 49 and 50%, which is a big delta. It's almost a 10% delta. What is also interesting, that the net bookings, they dropped from 2.6 billion to 1.4 billion for EUV. This is also showing a sharp decline, and shows just the struggles in the market. Because if you just look at the total sales, it went up from 6.2 billion in a single quarter last quarter in Q2 to 7.4 billion now. So the sales are there. The lithography systems that are being sold are there. Yeah. So there's not an issue on the revenue side. There's really an issue on the bookings and on the margin, which means that later the revenue will go or will be impacted, let's say. They still expect for 2025 the sales to grow to be between 30 and 35 billion, which I think is a large spread to estimate. I believe that in 2023 the company did something like 27 point something billion. So to only do 28 billion in 2024 is probably also a disappointment for investors. They would have probably expected more. And if you then look at it, right, the more gradual recovery, as they call it, on their logic business has a lot of impact, because they really see that there's a slower ramp of new nodes there and some push outs. So This is an issue for them, and we'll see how that goes. But what was interesting that we looked at, they weren't doing share buybacks in the last quarter. And I first thought, like, smart. If the share price is so high, do you really want to do share buybacks? But then I read, and they didn't do any buybacks because just they didn't have enough excess cash because of the slowdown in the down payments.
Yeah.
So if there's a lot of order intake which significantly dropped, it comes typically with down payments. They didn't have the down payments, so there was not enough cash to buy back shares. So that's really what they use it for. They also taken up more inventory because they don't want to slow down the build of these machines because they expect the demand to pick up again. These are long lead items, so they just continue producing. That's effectively what's happening. And they only buy back shares if they have excess in cash, which tells me that because of that capital allocation policy, ASML is probably a company that will always be buying shares on the way up and then on the most recent tops, and not buying back shares on the more recent bottoms. That's the result of their capital allocation policy. And it's a question whether you like that as an investor, but it was kind of this aha moment in my mind. But it's also interesting that they kind of take the down payments from the customer and straight away put it into the share repurchase program instead of the balance sheet or whatever, because they have enough cash there.
Yeah, it's quite an interesting one from them that they've, I don't know, has the whole market in general overestimated the recovery? Maybe based on the CHIPS Act or from what they've seen, but the whole market has been struggling for quite a while. Also, I think the press offer is getting sacked. They released their earnings 2 days earlier, early by accident. I think you have China. I noticed that wasn't mentioned much, but China represents 20% of their sales, I believe.
Yeah.
We know that there's ongoing conflicts between China and even Europe, and the Dutch government are looking at taking over the exports of these machines into China. So you've got that backdrop as well. So I'm not.
There's also this restriction on there, right?
And that will have an impact on their orders and backlog as well. So it's
and then the tension in Taiwan now with the Chinese. What were they doing? Let's say military exercises as such. So it's a tricky one. Look, clearly, right, this is a company with safe dividends. I think people should remind that if you want to buy it for the dividends. I think that the price to earnings is in a good space at the moment. It's not there where it maybe should be yet, so it's not like in cheap territory. But I believe, is it trading now at 560 euros? ASML, it was not too long ago 800 or 900 euros.
I have it at 664. I'm looking at now.
Sorry, 664? 660. Yeah, so it's quite a drop that the company experienced. So, and then the question is like, because people ask, am I buying now? I'm not buying yet. Here, I own one full share of them. It was always as a token of appreciation. I'm not buying yet. There's other stuff that I'm interested in at the moment, and the yield is just too low for me really to get a strong excitement here. Dividend yield, I think, is, what are you talking about? 1%. So
1%. So you're getting paid 1% to take on the risk
of the cyclicality of the business.
Of the cyclicality, which we don't know when it's the bottom or when we'll come out of that. We've seen weakness for the last couple of years, and then you've got this macro element on top of it that's playing. So
if you're like an investor that's more interested in buying on weakness and selling on strength, yeah, or more like a growth investor with a kind of a bit of a value component to it, and you still are able to estimate a lot of growth in the upcoming 5 to 10 years for this, then this may be, of course, a very, very interesting buy. And I'm not saying that it's overvalued, right? I'm just looking a little bit also more from a yield point of view, but probably from a discounted cash flow, this could be maybe an interesting one.
Yeah, yield is too low for me, so we'll stay away. But from one juggernaut to another, Johnson and Johnson released their earnings as well, which is earlier than expected. I always think Walgreens is the first company. Walgreens, for me, when they release it, I know that it's coming into earnings season.
Yeah.
But Johnson Johnson released the same day as Walgreens, which is a strange feeling. But yeah, I don't think there was a whole lot to report on it. I was reading it there for about an hour beforehand, and there's not a whole lot there. You were looking at it going, where's the rest? But look, their sales increased 5.2%. This is driven by operational growth, of course, of 6.3%. And they had some currency impact in their US sales. The big one is their earnings per share was down around 34%. And I think that's got to do with what they call IPR&D, which I believe is called in-process research and development. And that's basically, they've got a new company, I think it's this V-Wave company that they recently acquired, and they're integrating that into their own departments, and there's R&D expenses with that. So that's why that was down. But regulatory approvals on 2 or 3 drugs. Free cash flow was 14 billion. Dividends was 3 billion as well. Looks quite safe. So yeah, not a whole lot to report. It just looks kind of like an okay report from them. Their guidance was pretty much from last month as well. They are predicting some weakness for next year as well. They have guided on that. So they're saying that their medtech, they're looking to release new products, but obviously in their medicine, then you've got the Stellara erosion in Europe, which is eating into their profits. So they've called that out specifically. But other than that, they always do like 5 or 6% growth every quarter. It's another one of those, but earnings per share was the big one, and that was down.
Yeah, so it comes down to what we said before, right? The business is now really just a pharma company with medtech component in there, and the consumer business is gone, so there's no cushion anymore.
Yeah, exactly. And no cushion anymore. And when you flip through their slides, there's like 3 pages of just their brands. So they have nothing to say, just 3 pages. So you know they're just trying to fill the slide deck.
Yeah, they probably pay the company for that.
Yeah, exactly. But yeah, look, it's growth is what it is. It'll be interesting to see when we hit that cyclicality with that, or when it comes under a bit of pressure, how they handle that without the cushion of that consumer business. I think that's the key of these guys.
Yeah, I think Johnson & Johnson, I mean, how I look at it, right, it's kind of a bit dead money probably for the upcoming 2-3 years, while the company really improves the pipeline. That's how I look at this company at the moment. They need a few really good, strong FDA approvals to really get some schwung in the stock, right? Until then, it feels kind of a bit like the buy the dip, typical buy the dip stock. Yeah.
Okay. Good. We have quite a few listeners' questions, so we'll try to get through these. We'll start with the non-stock related ones first, because these might be a bit easier to answer. But Oleg has highlighted this week, RSA encryption was broken for the first time by a quantum computer. I did not know that. But it makes current cybersecurity standards outdated. Now, Oleg is worried about his broker account, since it can be, in theory, it can be broken. Do you have any thoughts on this?
Well, yeah, and he's right, but I tend to not lie awake too much from these kinds of things, because I use multiple brokers, so I've got a bit of a defense mechanism. If there would be any single person with a quantum computing that you know that would be interested in hacking our brokers, let me know. I believe that getting access to quantum computer in itself is already quite difficult. But I understand what he means there. If this really picks up and let's say and because these developments go really fast and there's nothing there from a cryptographic point of view that we can do to prevent this, yeah, then there's a long-term issue with anything we do digitally. It's not just our investment account, it's our bank account, it's our digital ID, it's everything. It just puts the whole digital space to a halt.
Yeah. I'm more impressed about the encryption than I'm worried about the broker being taken. If I'm honest, my portfolio, my portfolio size, I spoke about it, but I'm sure if somebody was going to hack into any of the brokers I own, they would go after big accounts. I would say.
Or small account. But what is my alternative? Companies don't even send paper stock certificates anymore.
Yeah, but what's more interesting to me is how this will benefit the pharmaceutical industry. We spoke about Johnson & Johnson a few minutes ago.
Yeah.
But I know quantum computer. I was quickly looking up there because I know I looked into Roche there a while ago, and they speak about quantum computer as part of their growth trajectory, and it's in their plans, and it's quite interesting. It gives the analogy here on the website. It says, imagine you're spinning a basketball on your finger. Under the laws of nature, the ball spins either left or to the right, never both in opposite directions. But the world of quantum computing is different. Here, the ball can revolve in both directions simultaneously. But they are quite bullish on quantum computing, and I'm sure a lot of the pharmaceutical industry as well. So this breakthrough is probably more helpful for pharma companies than it is for somebody hacking an account.
Yeah, but
I know there's different levels, but I mean,
we're talking here about encryption. Yeah, but I see what you mean. Because pharma typically has a computing problem at the moment. If you really, and there are some really good TEDx talks from a few icons in the pharma industry that really think about this, about how you can do research, and they all say it's kind of a computing problem.
Yeah, and it takes the first step. I know this is encryption, which is technically different, but we know how fast technology evolves. Once you break the ice, it opens a whole layer.
Yeah, my issue is that I don't feel that I'm, even though I work in the IT world, quantum computing blows my mind. I try to study quantum physics, and it's on the too hard pile for me.
Yes. I think it's on the too hard.
You just need to understand your limitations sometimes, and this is one of those where I tried even to read the books about it. The books there are a bit simpler, the books there are a bit more difficult. I just got stuck with this. My mind is probably too fixed to understand this.
Give me a 6-axis robot, and that's as far as.
Yeah, but how can a basketball go left and right at the same time?
It's like Schrodinger's cat. How's it in and out of the box at the same time? Who knows?
Yeah. Exactly. No, that's No, let's stick with analyzing Johnson & Johnson.
Yeah. But yeah, all the same, interesting. One of these things that could be a game changer in how the world progresses. Dara has recently received a debit card from Trading 212. That allows him to spend his cash from his account. So if he receives dividends, for example, he can spend that. Do you think this is a good idea, especially if you're in the early or middle stages?
I would just say reinvest the dividends. I mean, I mean, Trading 212. I mean, I know what they're trying to do, right? The more transactions, the more commissions they earn from this FX spread. I mean, I can't imagine taking debit card on my broker account to pay
Yeah,
the dividends with. It makes it too easy, and you want to increase the barriers to access that money.
it feels like they're competing with Revolut a little bit here, because
Yeah,
Revolut are a bank now. They've got a banking license, and it feels like trading 212 are going to go down that route and get a proper. I don't know what kind of banking license they have. They must have something, but yeah, Darren,
I
I think
would
it's.
take a scissors and cut my bank card.
Yeah, I have to be
Probably.
honest. Yeah, I think it's a terrible.
Yeah,
I think it's
exactly,
a terrible
exactly.
idea.
Yeah,
You have a bank account. If yeah, especially in the early stages, you want to be
yeah.
reinvesting as much as you can, because otherwise you miss out on that whole dividend snowball
That
that we're talking
maybe
about.
once you're living off dividends, it could be handy.
Yes,
If there are no hidden costs.
exactly. If you're retiring living off that monthly dividend, then it could make sense, because then you don't have
Yeah,
to transfer it out to your broker, your bank, and you might be able
yeah,
to save a few pence. But
yeah,
I think as an early stage investor, I think it's a terrible.
yeah.
Honestly, I'm sorry, Dara. I don't usually say this to people, but
Yeah, and
I
if you
know that
then
wouldn't.
have trading 212 and you get dividends from English stocks, but you don't live in England, you still need to pay tax over that. So then
Yeah,
you're screwed again when you do the tax forms.
but this is what worries me about companies like Trading 212. They come on, they have a nice interface, and you can get your own
Mhm.
pie, and people invest in them. But it seems to me if they have to go out and do something like this, they must be short on cash. And how safe is your money really then? So
Yeah, I personally don't think about that, but it feels to me a little bit like the Robin Hood then of the world, where I don't know, maybe it's something that Gen Z wants. I don't know. I mean, maybe it's something like that. But I feel like our philosophy around long-term investing is kind of like, putting money in an old sock somewhere, right? And then hoping that it grew 10 years from now. And
yeah,
you want to have as little as possible access to that to pull it out.
yeah,
Like I often say, I never even checked if I can transfer money out of my accounts. Yeah. So yeah, no, please. I would say, Derek. I mean, it's your money, your worries, but yeah, I think our answer is clear.
yeah. Ekriv from Belgium is worried about Belgian taxes on dividends. They're quite high at 30%. And he's asking, would we still be a dividend growth investor if we lived in such a country with high taxes?
Well, you can answer that.
Yeah, of course I can, because I live in Ireland and our taxes are also quite high. So we have a couple of options here. So I can invest in ETFs. Guess what? Taxes are high. Okay, so you're looking around 40% on dividends received from ETFs, and you're looking at capital gains tax when you sell. You got this deemed disposal rule, which I despise, and we spoke about. We can own real estate here, but guess what? If I rent out that house, I'm taxed at my marginal rate. I'm a high earner, so I'm going to be taxed 52% of my income. What if I want to sell my house and sell my investment? I have to pay capital gains tax, which is also above 30%. And yes, dividends, you're also taxed at your marginal rate here, either way. So whatever way I look at it in Ireland, I am caught and I'm paying a high rate of tax. So I think you've got to look at it after tax. I don't know Belgium that well. I don't know if there's any instruments that are more tax favorable. For example, ETFs, is that a better way of investing? Maybe it is. But the question is, if I lived in such a country, would I still be a dividend growth investor? I live in such a country and I am a dividend growth investor. So
And you made it to the first 100K,
yeah.
and you have more than 500 euro monthly in dividends.
I mean, you have to accept that it's not always the most tax efficient way to make money, but no matter what you do, there's always a tax implication to that. And unless you're an expert in that field, or you hire an expert in that field, you're probably not going to know all the nuances anyway.
Yeah.
So for some that invest monthly with my income, I'm very happy to be a dividend growth investor, and I look at it after tax rather than before tax. Such as my income, as we spoke earlier, everything is after tax. David from Sweden. Here in Sweden, investors need to choose between an ISA account or an AF account. With ISK, we pay a yearly fee that is tied to the national interest rate. The fee is currently just over 1%. And there's no tax on dividends or capital gains. I need to move to Sweden, but there's no tax on dividends or capital gains. But with an AF account, we don't have a yearly fee, but we pay 30% tax on capital gains and dividends. What would you choose?
I'm just not. I don't totally understand that. Is the fee 1% on your entire income, or only on the dividends, or is it, for instance, on the portfolio size, the 1%? What is the 1% on?
I would assume it's whatever you have in that account, because otherwise it wouldn't really be a question, I think.
Yeah, then I would need to do the math. But for instance, if your dividend portfolio is yielding 3% and you pay 1% fee, then you pay similar to the 30% tax on capital gains.
Yeah.
Yes. So I guess it depends a little bit on the dividend yield of your portfolio then.
Yeah, and the size of your portfolio as well, I would imagine.
Yeah.
If you're just starting, it sounds to me like an ISK is where you want to be. But I don't know how easy it is if you can transition between as well. Can you do that? I don't know. But purely on those numbers, I'd say with a small account where the maths make sense, ISK. And then once you get to a larger account where the 30% tax on dividends is less than your 1% fee on your portfolio, I would go with that.
It kind of forces you also to go for a high yield portfolio in the ISK and into a low yield portfolio, and a more growth portfolio in the AF account. That's how it sounds like.
Yeah.
Assuming that you don't want to sell really in the next 10, 20 years.
Yeah.
Yeah, or that you buy those metas of this world that then start paying dividends. Yeah.
I feel like if I was in the AF account, I would be investing in accumulating ETFs. So you're not receiving that dividend, and it's been
provided that you don't have a dividend leak in the ETFs. We discussed that in Facebook as well the other time.
Yeah. Nice question. Darshan has asked us, it's his first ever question, but he's been following since the start of the podcast. What's took you so long? But no, I'm joking. Thank you for the question. But his question, as an example, golf, paddleball, and pickleball are currently growing in popularity as sports. Do you ever look at growing industries and invest in a company associated with that industry that may pay a dividend, but it's under your minimum dividend criteria at the moment?
I'm not against it, but typically you enter then the small cap and the mid cap world, and I'm usually not really fishing in that pool a lot. I have a few in my portfolio, but generally I don't have anything against it. I do believe you want to have the rising star. The issue is for me that I find it hard to evaluate growth stocks, because usually the multiples for me, to what I'm used to, they make no sense. And I find it really hard to predict the growth of, let's say, doubling sales every 2 years.
Yeah.
It's just I learned about myself that such aggressive growth, I find it hard to understand. And that's why I tend to avoid those companies. I know I miss out with that, but c'est la vie. I mean,
yeah. He's given the example of golf and then Nike. But if I'm honest, Nike is probably making more money off basketball, football, baseball, and golf is probably a small. I mean, for me, it's hard. Yes, like you have a single person wearing Nike clothes wearing golf, but the money is probably in the golf clubs, and Nike are not making the golf clubs. And I know lots of people spend a lot of money playing golf on fees and so on, but yeah, I would never pick Nike because of an up-and-coming sport like golf or pickleball or paddleball. I feel like pickleball and paddleball are more like niche sports that will grow to a certain extent, but they're never going to be worldwide. You're not going to have like like what you see in the basketball or football. You're not going to have huge crowds at these. Where's
I don't know. I never
I
say
can't.
never. Nike was also a small company, started with selling sneakers from a truck, right?
Yeah,
From the trunk of the car, and their main mission was to beat Adidas, and now here they are. So you never know. But yeah, I tend to go to the blue chip stable companies.
yeah. It's too hard to distinguish what's a fad, what's here for the long term, and what's here for the short term. And look at EVs, for example, electric vehicles.
Yeah,
That's one example I can give as well.
yeah.
But yeah, nice question, Darshan. Manny Mystery, who was on here last week, has asked us. He said, "You have too much dry powder. There are no new companies you would like to add, and there is only one current company in your portfolio that is at your buy price. There's a catch though. You are fully allocated on that company. What do you do?"
So this is a hypothetical question because in reality it really doesn't happen
Yeah,
that much. Yeah, although sometimes we don't know what to buy really, that we lack inspiration, but in my opinion there's always something to buy. I would if there, so I've got money left, so I wouldn't want to postpone the investment of the money. There are no new companies that I like to add, and it's really only one. I would always pour the money in something that I have a conviction about. So I would probably pour it in my existing holding that is already fully allocated and stretch the allocation there. Yeah, that's probably what I would do. And then I could always rebalance in the future if needed.
yeah, me too. Exactly what I would do. MMAC, do you think SCHD ETF will ever be available for European investors?
This particular ticker, probably not. No, but maybe an equivalent to it. I hope so.
Yep. It's so hard with European ETFs, isn't it? It's just unnecessarily hard.
Thank you to the European Union,
Yeah, yeah. Mayak has asked us about Target, ticker symbol TGT. He's currently analyzing them, and he's surprised with this quote from the last 10K. And the quote is, "Our board of directors authorized a 15 billion share repurchase program. Under the program, we have repurchased 23.8 million shares of common stock at an average price of 223 euro." The commas always throw me off with the European style. But yeah, $223. And almost no shares were purchased when the stock was about 50% lower. What's your thoughts on this?
Well, it's of course really weird, and we just spoke about ASML, so I don't remember exactly what the capital allocation policy was there, but you see this a lot, right? I own Target, by the way, so as full disclosure. But of course, I mean, we are schooled by Buffett, yeah, and we all learn you should buy back shares when your company is under a certain valuation, whatever. I would love to say that CEOs tell us like EDGI or every investor, if the multiple goes under 18, we turn on the buyback. When it goes above 18, we turn it off. Something like that. Or we make it half of it. And then above 20, we turn it off. That's how I would love to see it. Yeah. It's kind of what Buffett does, right? He says like above this we turn on, above this we the way around. That's how I would love to say it. And Target seems to do the total opposite. And we see this with many companies, because when they have excess cash, they don't know what to do with it, so they spend it on buying back shares. And when they are struggling, they turn it off. Yeah, so that's what it is. They don't like money on the balance sheet. I love it. I would love to have every company chasing a AAA rating first.
Yeah. I don't understand how they bought back at that price though, $223. They haven't been that price since 2021. It's confusing me.
Yeah, it's maybe yeah.
Something to look at. Yeah, I don't understand that, but yeah, I would we love a good dividend policy here, but I would also love a good share repurchase policy. Be clear, tell us when exactly or what conditions you're going to buy back shares. And I think then it would be easier for us to analyze what the board are thinking at that time.
Yeah.
Okay. Green Pepper has asked us about European beverages stocks like Diageo or Pernod Ricard. And I think it's been asked quite a few times actually over the last few weeks. And not surprisingly, their share prices are tanking. I think Diageo still has a little bit to go, if I remember correctly. But Pernod Ricard has piqued my interest. And somebody asked this question last week as well. So I'm doing a deep dive on them at the moment. I have one solitary share of them because they are the owners of my favorite drink, which is Jameson. And I remember buying that share and the share price kind of took off. But they've been growing. If I remember, they just grow their dividends quite good actually in that time. So I think it's a good time for me to do a proper deep dive.
Yeah.
There's lots of things happening in that market as well. Again, China has an influence there. So we'll see. I'll be able to give a proper answer on that this time next week. But
Diageo is now yielding 3.1% almost. It is trading at early COVID crisis prices, but I still find it too expensive. Maybe I'm just a Scrooge, but if you just look at the data, I just don't find it attractive enough.
Yeah, me too. I still think it has to drop 20% if I'm honest.
Yeah, exactly.
We will see. But Pernod Ricard is definitely one that I want to look at. I don't know if you know much about them, but they own a lot of premium brands. So you name a premium, like Absolute Vodka, they own it. Malibu, they own it. Go to America, think of all premium bourbons, they probably own it. So they are like the LVMH of the wine and spirit world, I would say.
But LVMH has their own as well with Belvedere vodka, which I think is more premium than Absolute vodka.
More premium than budget premium vodka.
Yeah. Remember, size does matter.
Yes. Fire Pete, what do you think about ticker symbol TISG? It's the ultimate luxury stock for billionaires.
Yeah, very interesting. So I Googled it and I discovered that this company is called Italian Sea Group and they make luxury yachts, not just a yacht. Hallelujah. Yeah, these are probably for the Abramovich of this world, right? This old owner of Chelsea. Look, there's not too much information available that I could quickly look up. They have a dividend payout ratio of 40 to 60%. Maybe this is the equivalent to a Paddle stock that we were just talking about. They have been growing earnings, so that means the dividend must have been growing. I was not able to find it. I think it IPO'd only in 2021.
Okay.
But dude, if you see those yachts on the website, I mean, not in my life probably. I will probably not even be a visitor one day on such a yacht. Yeah, let alone own it.
I'm just looking at him there. To get into the site, I had to confirm I wasn't a robot, so I'm glad they've let me in. But man, there's some yachts there, and even the small ones like speedboats are luxury speedboats. They look incredible.
Yeah, exactly. So, I mean, it could be one to research a little bit. And you know what it is with these luxury things? I think there's always a market for this. It may be a bit cyclical, but I feel there's always a market for this.
The rich and famous always want what the average Joe can't have, and this is something that we can't have.
Exactly.
I'm nearly sure we got this question about this company before, and I don't think we looked at it as much as this, but we might learn from our snap-on. Remember, we dismissed that the first time, and someone came back, so it might be worth looking at.
Yeah.
Joe's broke, dude. Do you have a small to medium-sized companies on your wish list that pay dividends? So it's possibly more risk, but also an option to grow their dividend considerably.
Well, the one we just discussed, maybe.
Yeah, exactly. Exactly. No, there was none on my list. I went looking the other day. I was looking at some Swiss company that do polymer, but then I realized that they cut their dividend twice.
Yeah.
So it's back to the drawing board. But there was an Italian company, Sembra, if you remember, that were quite good as well.
Yeah.
But not on my watch list. But if you're
Yeah.
interested, I want to look at. El Cuba, what's your top 5 best insurance companies on the market?
Funny enough, they will be all in Europe. For me, the gold standard is Munich Re.
Mm-hmm.
That is by far the one that I'm most impressed with. I mean, get a more boring reinsurer. Then I would say ASR Nederland, Allianz, NN Group. Well, you may give the fifth. At least 4 I could give.
Yeah, 4. But Aflac, I think, have to be in there. I know they're not European.
Aflac or Chubb.
Yeah,
I think true.
Yeah,
true.
Martin, what have you both been buying the last couple of weeks? I think we spoke.
Yeah, we spoke about that in the earnings report.
Oscar has asked us our thoughts on Nestle. Seems cheaper now, but I'm concerned regarding stagnating business of the last 10 years versus the ever increasing debt.
Yeah, same here.
Yeah, that was my concern as well. Increasing debt, low growth.
I don't see a catalyst for proper strong growth for this company. I just don't see it, and that's my issue. So I believe that the dividend will grow slow, below average.
I think that the growth we will see will come with the currency. I know that the currency has been depressed for a long time, so we might see, I wouldn't say artificial growth, but we might see growth if the currency situation improves. Dividend Gardener, has Spirax entered into the buy zone for either of you? So I analyzed this company, I would say 3 or 4 weeks ago on the newsletter. Really, really nice company, I have to say. But there's a couple of red flags for me. One is their acquisition policy, and since that, you can see that the return on invested capital over the last 10 years has been decreasing drastically, as in it has halved over the last 10 years. So I think they struggle to integrate the companies into their existing business. It is quite cyclical as well, and they're struggling with production at the moment. So the production demand is quite low, which means that their orders are quite low as well. But relatively speaking, it's trading at a 23 PE, which is, I'm doing like the inverted commas, which is cheap if you look at them over the last maybe 5 or 6 years, but I wouldn't say it's overly cheap. I'd say it's more fair valued at the moment. And yeah, I'd like to see it drop another 5 or 10% before I call it cheap. But yeah, I think it's a good company and definitely worth looking at. Vivera Dividend 2. Apart from your current holdings, are there any real estate stocks you would like to own?
No, I think I own the ones that I want to own. Nothing else really. I think I own the ones that I want to own. I mean, there are a few of those like that are A-rated balance sheets that are more in the Sun Belt in Florida, but I find them too low yielding and not attractive enough. So I think there are only 5 or 7 A-rated, with a credit rating A, real estate investment trusts, and 1 or 2 of them are from that Sun Belt, but not interesting enough, and they won't be interesting enough, I think, for a long while.
Yeah. The only one well, it's not an investment trust on its own or real estate investment trust, but more so an investment trust in the UK, which is TR Properties, which I spoke about. Because I think the European landscape is just so hard with REITs, because sometimes they're not even real estate investment trusts, even though they look like the same thing. So there you get a fund manager that knows what they're looking at and what they're doing. So that's the only one that I would consider. But other than that, there's none other on my radar. JH Investments has asked us about American quality stocks that we are considering at the moment. Target is on my list. I have to say, we spoke about them earlier, but they are down to $155. I think I have fair value around 175, so they look quite interesting, I think.
Nice.
You?
Nothing in particular.
Okay. And then the last question came from Sven, and he's asking us about Ahold. I don't know, was there something in the news? Was there earnings? We missed
No,
something?
there was this week, I believe it was UBS that has a sell rating for £27 on there. They expect a bit of competition in the States, compressing the margins because they will need to probably fight a bit on price, but then also the tornado there and da-di-da-di-da. So the stock went down with several percents on a single day. You know my thoughts about this. I mean, in the end, analysts create. I think analysts even believe themselves that it's the best to try to buy low and sell high. Yeah, because that's what they're doing. They're saying like, oh, our algorithmic model said like, oh, it's worth less now because I don't know, there's a bit of margin compression. So the next year we expect it to go to 27 euros. So sell your shares, and when they are at 27 euro, maybe at 25 euros, buy them back. And then later on, when something happens, and maybe after Q3 it wasn't that bad, they will reiterate to 29 or 30 euro, and then they sell again. You should buy it. I mean, they are just stimulating the behavior of the investor mindset of buying low and selling high, which we know is very, very hard to do.
Yeah.
And that's what I don't like about analysts. So they may be right about the data points and such. They may be right in their thesis, but it doesn't stimulate a long-term investor mindset. And this is what I'm always a bit having against the analysts.
Yes, they're not looking at the underlying fundamentals long term. They're just looking at the share price volatility, and they have to, not all analysts, but I mean, people need to watch the TV, they need to keep you engaged, they need you to read the news. And if the news only said buy and hold,
exactly,
nobody's going to watch that. So
yeah,
take from it what you will. But our position has not changed on Ahold.
No.
Nice one. That was the last question. So again, thanks to all our listeners for sticking around. Thanks to you for sharing your portfolio review. I'm sure it's inspiring to others as it is myself. And to all our listeners, we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.